All right, guys. Congratulations to the people who made profit yesterday. Not yesterday, I mean in the last week on EUR USD. We spoke about how to trade the EUR USD last week before FOMC, and it was a bullish signal. And we were talking about EUR USD staying around 0.615 because the video was made when EUR USD was around 0.611. So before FOMC, it went up to this area, which is 0.67T. So yeah, people made profit, and then profit taking took place, which is why market came down. However, it didn't. Yeah, sorry. Here. So this was the movement before FOMC, and profit taking took place, and market came down from 670, 680 area back to the previous support area, which is something around six. Sorry, five. Look at the low. 516. So this has become a new support now, 515, 516 area, and then there was no changes in the policy statement of FOMC, and there was no hike in the Fed interest rate, which is why Euro USD continued the uptrend, and people got further benefited by the bullish bias. And we didn't talk about how to trade NFP because it's not possible to make video on everything on daily basis. However, you have seen that the overall result of non-farm payroll, year over year hourly earning release, and monthly hourly earning release, and employment rate. If you combine unemployment rate, so if you combine all of these four data, you'll find that the overall picture was negative, which is why there was a significant bullish move in all the currencies versus US dollar. And now we have this bullish candle, which can we call bullish engulfing candle, and moreover we have a bullish engulfing candle on the weekly time frame. So two significant time frames, two candle pattern based on the fundamental factors. So this is not just a price action out of nowhere. This is supported by the fundamental economic factors, which is why picture is more clear now that having a bullish bias is not a bad idea. And now we're going to talk about what is next. So next is the next support, next support or resistance, obviously. So next resistance here is Fibonacci 50%. Many people will argue, why 50%, why not 61.8%, why not 78.6%, why not 38.2? So there is an answer to this question, because this Fibonacci 50 label is supported, is not just a standalone resistance, it is a confluence resistance, which was earlier three swing lows. You can see here one swing low, second and third. That's why this is going to play as the significant support, which is something around 850, 108.50. And now question is how we should enter the position. So there can be three different ways of entering the position. The people who are very conservative can wait for a significant retracement to enter the market, so that their risk from here to this point will not be more than their reward from here to this point. Simple way. And some people would say, why I should wait for this? Maybe if I'll wait for this and market will not go down, I'll just have to skip this opportunity. So that kind of person can enter a position now and then enter a position again when market falls down, and once more and once more. 4, 5, 6, 7, 8, I don't know how many multiple positions. But there is a formula on our website talking about how to do multiple position trading in a calculative manner, not to blow your whole account. You can do this just by reading, understanding that formula. So go to our website, go to education, go to strategy details, and then there are two videos decoding the formula of using multiple positions. So even if you're going to use multiple positions, you'll have to make sure that the average of the multiple positions will stay certainly at such a level from where your risk to this point shouldn't be bigger than your reward from this to this resistance. So that's what you can decide how you want to do the multiple position trading using those formulas. So these are the two ways. And third way is just to open a position and stick to the position as long as there is a price action supporting your position, or else you can take the loss, close the position, and you can plan to re-enter the position once market will fall down to any significant retracement level, and then market will show you bullish continuation. For example, let me right click on this. I will make it sure that it will not be visible on other time frames, not to conflict with other tools, which I'm going to show you. So let's go to 4-hour time frame, and we have this move to the upside from this point to this point. So we are going to just mark this move by this uptrending line, which I will right click, uncheck the ray, and this is now looking like just a uptrending line. Let's go to 4 hour and let's draw a Fibonacci retracement. And I will simply mark it default so that it will show you all the levels of Fibonacci on this 4 hour time frame. So defaults, okay, and now we have all the levels from 00 to 100%. So we do not know what kind of retracement we're going to get to the downside before further upward continuation. So I'm not suggesting any buy limit placement on 38.2 or 50%. But yeah, if market comes down to 38.2%, then if we measure the distance from this level to our resistance, definitely we are going to get sufficient number of pips on the reward side compared to the number of pips on the risk side. So of course you would like to wait for market to fall to 38.2 and then you would like to enter a position after you will see a bullish continuation, maybe a bullish candle pattern here or maybe something else, not just the candle pattern, maybe some chart pattern on maybe 30 minutes chart. So this is another way of entry. So we have now three different ways and you can decide how you want to enter. You can enter one position and at least stick to that one position which will give you this number of pips right from here, which will be something around 100 pips. So basically you're going to ignore the risk reward comparison, so you're going to risk more and you're not going to just leave this skip this opportunity of making 100 pips just because we have a very strong bullish bias. So this is one way. So you're going to basically enter buy position irrespective of how many pips are there on the risk table. All right. Second is multi-position trading, and third is waiting for market to come to a retracement level, show the bullish sign, and then you enter. Very safe method, but this is the way you can even like you'll not even get the chance, and maybe market will never come down, and it will go to 850 right from here without retracing down to this area, which is something around whatever 660 or something around this. So yeah, some people like to rather skip the opportunity than taking the entry. So if you are one of those people who are very safe player, you can follow this method, and later you don't need to regret of skipping this opportunity, right? So that's all, and thank you for watching.